Hello, and welcome back to yet another exciting week on the stock market. In this week's episode of the Lazy Money Game, we will walk through some of the financial news. Then I will give an update to my portfolio and talk a little about what I have invested in within the week. And since there was a viewer who asked if I can go into a little more detail about why I invest in the companies that I have done, I have decided to try and do that as well. So let's rush into the financial news and start with the most important, at least in my humble opinion, from the US Bureau of Labor Statistics, since we have the king of key figures out on September 4th, namely non-farm payrolls from the United States. So if we take a closer look at the report, we can see that the non-farm payrolls employment rose by 1.4 million in August and that the unemployment rate fell to 8.4%. And if we take a closer look at the chart here, we can see that it is drastically decreasing from when it topped back in March this year, but we are still at a very high level compared to where we usually are. It is, however, as always, very important to pay close attention to the details. So if you go further down in the report, you can see that the employment in the government has increased by 344,000 people, meaning accounting for roughly 25%, and of those people, 238,000 were temporarily census workers. So maybe this number is actually not as good as it looks initially, at least not if you compare with analyst estimates. So with that job report in mind, if we then take a closer look at the S&P 500 for the last week, we can see that the job report was out 3rd of September, and hence after that we have seen a drop in the market, which is not too surprising since the report was worse than expected. We could also have looked at the Nasdaq instead and looked for the weekly chart here as well and see that we also saw the drop here. I'm not saying this is only due to the fact of the job report, but I think it plays a huge role here. Another factor which potentially have played a huge role in this severe drop was released in an article on Friday where it was revealed that SoftBank has been making massive bet on tech stocks. This has been revealed in an article from the Wallstreet Journal, the Financial Times and Economic Times. I will of course include links in the description below. Unfortunately, the article from the Wall Street Journal is behind a paywall, but at least you will be able to read the article from the Financial Times and the one from Economic Times. Here we can see that SoftBank has been buying shares in these tech stocks like Tesla, Alphabet, Netflix, Microsoft and Amazon, and on top of buying the individual stocks, they have been buying call options, so they have had an exposure for around 50 billion US dollars. Whether or not this has led to the decrease in the value, if they have stopped buying this on Thursday, still remains to be confirmed, but it seems like a plausible solution if you remove 50 billion US dollars of demand in stocks, that the stock will drop severely. If you are not familiar with the concept of options, let me just try and briefly explain it here. Buying an option is buying the right to buy or sell something in the future. For that, you pay a premium today, since you get an optionality. In the case of SoftBank, they have been buying call options, meaning that they have been buying the right to buy a stock at a predetermined price at a predetermined time. So they pay a premium of, for instance, 5 if we take a look at this diagram, and then we see the strike here is 50, meaning if the underlying, meaning the stock in this case, has a value of more than 55, then the option will start to be worth something. Because if you have the right to buy a stock at 50, but the stock is worth less than 55 when the option expires, then you have lost money since you have paid a premium of 5. And as you can see here on this diagram, the more the stock increases in value, the more money you will gain from your option. And in theory, there is no limit to how much you can earn from a long call option, because in theory, the stock can increase indefinitely in value until the option expires. Why are these options interesting when you are talking about the severe drop that we have seen on Nasdaq? Well, let's assume, for instance, that SoftBank stocks, or rather SoftBank's options, has expired on Wednesday. That means that there have been a huge demand for stocks, since whoever have sold the option to SoftBank will have to go and buy the stock and deliver it to SoftBank, meaning that there have been a huge demand for the stock. And then on Thursday and Friday, if there's no one else who is willing to buy, then we are potentially left with a lot of sellers and not that many buyers. And what happens if we have a lot of sellers and not that many buyers? Well, then the stock will typically go down in value, as we have just seen here on Netflix, for instance. And if we then go and take a closer look at my portfolio, the first thing we notice is that there was a green circle for this week's episode, meaning that the portfolio is up in value. The portfolio is up $500 compared to last week, but I have also invested $500 into the portfolio, so you can say that it is actually the same value. But since I have received $50 in dividends within the week, then I think it's fair to assume that the portfolio is actually up in value. And if we take a closer look at what I have invested the $500 in, then they went into Cardinal Health. And as mentioned, the $500 is a mixture of dividends and fresh capital. So if we take a closer look at the dividends, we can see that I'm already up to more than $50 this month. This is a little more than $10 from LTC, a little less than $10 from Wells Fargo, since they have slashed the dividends by 80%. So last time I received the dividend from Wells Fargo was back in June, so I would expect that this month's of dividends are lower than what we saw in June, despite the fact that I have been adding more cash into the portfolio. But whether or not that holds true, we will see when September is done. And the last company which has paid a dividend is Pfizer. They paid a little more than $30, bringing the total to a little more than $50. So this week, the portfolio has contributed with a little more than 10%, which I'm really happy to see. So let's take a closer look at Cardinal Health, since there was a viewer who asked for why or more information about the companies which I'm actually picking. So let's try and dive deeper into why I chose to go with Cardinal Health for this week's investment. So let's take a closer look at Cardinal Health. I do that by going to Seeking Alpha. Allow me just to zoom in here. So if we start on the dividends tab, guideline number 1 says that the dividend yield should be 3% or above, which it is. Then we have a payout ratio which is well below 75%, which is my guideline number 4, and a strong dividend history, 24 consecutive years of increasing the dividend. That is guideline number 6, which we can say is also easy to approve here, since next year it will become a dividend aristocrat, meaning that it has 25 consecutive years of increasing the dividends. And if we then go to dividend yield here, we can see that the forward dividend yield of 3.91% is way above the 4-year average. So this means that this is at least a decent time to buy. If we then go and take a look at the peers to see if this company has a PE ratio which is in line with its peers, and if we scroll down, we will find it here, and we can see that Cardinal Health is well within its peers. I can see that AbbVie is lower. I also have AbbVie in the portfolio, so I would say that this is a pass so far. If we then look at guideline number 5, diversity across sectors, well, then you can say Cardinal Health is a healthcare company, and that is already in my biggest positions or my biggest sector in the portfolio. So you can of course argue and say, well, perhaps you shouldn't add more into Cardinal Health, but currently I think it is at an attractive level, and since it is the smallest holding of my healthcare companies in the portfolio, I have no problem by adding more money into that. If we then continue to the most time consuming, meaning guideline number 7, to check for a strong company potential and a good moat, I always start by doing a simple wiki search, see what is this company about. So Cardinal Health is an American multinational healthcare service company, which is the 14th highest revenue generating company in the United States. So this is really a big company. And what we can see here is, at the bottom line, Cardinal Health provides medical products to over 75% of the hospitals in the United States. So I think it's fair to say that they have quite a good moat since they are simply so large. And for a strong company potential, then I suggest we go and take a closer look at Cardinal Health's webpage. Then I go to the investor relations and check their latest quarterly update and see on their financial expectations. What do they expect? So what should I expect from this stock in order to align my expectations? And here we can see what they are expecting for 2020 and what they have actually realized in 2019. And overall, it seems like they are hitting their targets pretty well. If we then scroll down here on the segment outlook, we can see on the pharmaceutical products, or on the pharmaceutical segment, they are expecting mid-single digit percentage decline. So they actually expect to lose money. This was previously low single digit, but due to the current situation, they are expecting to lose more there. And on the medical side, on the profit, they expect low double-digit percentage growth. So overall, I'm still happy to invest in the company, but it could of course have been better here, since you do not want to buy into something which has a declining profit. But in the current market situation, for me, this is at least still good enough for me to buy more. So now that we have established that Cardinal Health can pass all 7 guidelines, I still think it's very important to be realistic about your expectations. I don't expect this company to be the next Tesla, meaning that it will blow up in value. I'm simply investing my money here because I'm happy to receive these 3.9% in dividends. And one thing that I like about the company is that it has quote unquote only dropped from around $60 in value and down to around 40, and now is up to 50 again. So it has not been as volatile as many other stocks we have seen. So I think this is a better place to put my money, since they are at less risk than some other companies where you would have bigger swings. And if we take a look at the 5-year chart, we can see that the stock is actually still down. And on the 10-year chart, we are only up around 60%. But what I like about the time and point where I'm buying this company is that the PE ratio currently is around 9. And I think it's fair to assume that the fairly priced PE ratio for this company would be around 14. So if I hold this company for, let's say, 10 years and the PE ratio goes to 14, then I will also have some capital gains, simply because the stock would have increased in value as well. I'm not saying that this will increase extremely, but I do consider this stock to be undervalued, and that is why I want to add more into the company, despite the troubles that it is currently having. So this was just a quick summary of the guidelines and why I think they are a good starting point for you. But as always, remember to do your own due diligence. And just because I think that the company fits me doesn't mean that this is the right company for you to buy. And to look at some of the news within the portfolio, it makes me very happy as a dividend growth investor to see that Verizon Communications has increased its dividend by 2%, bringing the forward yield to 4.14%. So that concludes yet another exciting week in the Lazy Money Game. So in this week's episode, we saw the US unemployment numbers, we have the news regarding SoftBank. I tried to give a little explanation about what a call option is, for those of you who do not know anything regarding that. Then I gave an update to my portfolio, where I just took it one step deeper regarding why I have invested in Cardinal Health. So hopefully you feel that this has answered one of your questions from last week. And until I see you next Sunday, remember to comment, like and subscribe. Bye!